Good afternoon, and welcome to the Shearwater Group PLC final results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab situated in the right corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Phil Higgins, CEO. Good afternoon to you, sir.
Good afternoon. For those that are new to Shearwater, I'd just like to take you through a brief introduction. At Shearwater, we provide cybersecurity, managed security, and professional advisory solutions to help create a safer online environment. We have two divisions that make up the company. Within our service division, we have three companies. Brookfield Solutions provide next-generation cyber tech and services. Xena Consulting provide professional advisory and audit. Pentest provide red teaming, penetration testing, along with their newly released training program. Within our software division, we have Secure Envoy, which provides next-generation converged access management platform, and GeoLab, which provides sensitive data discovery. I'll come on to a little bit more about some of the changes we're making to the company in later slides. Some just general stats here for you. Our service division produces 89% of our revenues and our software 11%. We have circa 100 staff, and our products and services were sold to 49 countries during the period. And we manage that all from 5 offices in the UK. To take you through some of the results of last year, Paul will cover these in more detail in his financial review, but to give you some highlights. In fiscal 23, the company did face some challenges due to the cautious customer behaviour in the uncertain economic climate. This resulted in a decrease in our group revenues to 26.7 million from 35.9 million in fiscal 22, and a negative adjusted EBITDA of 200,000 compared to a positive 4.4 million in fiscal 22. This was mainly due to contractual delays in the fourth quarter. Despite these financial setbacks, though, the company did maintain high engagement levels and acquired 113 new clients during the year. Also, during the period, the company took decisive action to streamline operations even further and improve the efficiency, making the business more lean and productive. Additionally, the company's strong customer base of blue-chip organisations across various sectors provide a solid foundation to move forward. To overview our offering, the group boasts an impressive array of cybersecurity capabilities. With its companies enjoying a stellar reputation in the field, they are all award-winning. This aligns perfectly with the current market trends, where cybersecurity is of the utmost importance to organisations. Shearwater has transformed into a more agile, specialised and focused business. Thanks to recent operational adjustments made, it has maintained long-term customer relationships with prestigious blue-chip organisations across various sectors. Increased investment in research and development has notably enhanced our software solutions. Furthermore, the company's robust balance sheet, improved visibility and growing pipeline of opportunities strengthens its position as a cash-generative business. This is all supported by a seasonal board, leadership team, industry thought leaders. Overall, the company is confident in its ability to achieve solid, sustainable revenue and profit growth during the coming year. So, some of the changes that we've implemented. We've agreed to work on the merging of Xena IS, Xena Consulting into Brookfield Solutions. The reason for doing this is to streamline operations, reduce some of the complexity, and simplify the group's message. The services accounting for 89% of the revenues, primarily from blue chip clients in banking, telco, and technology sectors. Despite the challenges the services division excuse me, despite the challenges in the services division, we did expand the team to meet the growing demand and introduce new products across Xena, Pentest and Brookfield solutions to strengthen their overall service offering. Today we'll look at the software division. We've merged the GeoLang into Secure Envoy to create a more cohesive software company, increasing cost effectiveness and enhancing operational performance. This unified software company will be referred to as Secure Envoy and will benefit from a significantly strengthened position and its offerings as a result of continuous increase in R&D spend. If you look at the progress in fiscal 23 with Secure Envoy, it released its management software platform, version 3, which helps organizations manage and control access to their system software. With Secure Envoy's solution via a single sign-on, organizations can enhance their security measures, ensure regulatory compliance, reduce supply chain risk, simplify management of users accessing the corporate systems via a single sign-on, with geolocational control on that access. In fiscal 23, GeoLang introduced a fully functional enterprise-ready software that was developed for sensitive data discovery, and is now being used by a leading bank and attracting interest from other existing clients and new prospects. GeoLang will benefit from operating underneath the recognized brand of Secure Envoy and gaining access to its global reseller base. This is all underpinned by continuing investment into our software and bringing new service offerings to market. With that, I'd like to now hand over to Paul.
Thank you, Phil, and good afternoon, everyone. Starting with this first slide provides a breakdown of the summarised P&L of the group, starting with revenue of 26.7 million. We have seen, as Phil mentioned, a reduction in year-on-year revenues, which is primarily as a result of Q4 delays, which primarily in the services side of our business, whereby at the end of the financial year we saw the delivery of some deals taking a bit longer as a result of client request, and in addition, as Phil mentioned, the conclusion of signing up some deals being slightly delayed. It's pleasing to say, though, that as we start the new year, we have seen a number of these delayed opportunities completing. We're seeing delivery of some of these opportunities now coming through and flowing through in Q1 and beyond. And with the remaining opportunities, we are seeing progress there as well. In terms of gross profits of 6.4 million, it's worth noting that the profitability at a gross profit basis is slightly down on the prior year, 24% versus 30%. There's a couple of one-off items that have impacted this. So within this number, a one-off unrealised FX expense has suppressed the gross profit margin, and also some additional investment into adding sales generating capacity into our advisory teams has initially suppressed the margin. So if you're adjusting for some of those items, that profit margin is not too dissimilar to that of the prior year. In terms of administrative expenses, we have seen an increase on a year-on-year basis, things such as inflationary pay increases to members of our team, in addition to other increases in infrastructure costs across the group, have been offset slightly by efficiencies and reductions in corporate costs. So we have seen a circa 4% increase within this expenses line. At the end of the year, obviously, an adjusted EBITDA loss of 200k does reflect, to a large proportion, the benefits of those delayed revenues in the period. I'm not going to go through every single line on this. As you can see, a number of the items below adjusted EBITDA remain constant with the prior year. However, it is it's worth flagging two things. The amortization of intangible assets, computer software. There's a slight reduction here, and the reason for this is that there are some historical projects that were fully amortized in the previous year, which has given rise to that slight reduction on a year-on-year basis. And additionally, obviously a more material expense, which is a non-cash impairment charge, which has been made in the year. And this reflects a write-down of goodwill values held for the group's Secure Envoy and Xena assets. Incorporating this impairment charge for the year, it does leave a loss before tax of 9.6 million versus 900k profits in the previous year. The next slide provides a divisional view of our services division and our software division. So starting off with our services division, revenues of 23.8 million are down year on year by circa 27%. And again, as mentioned in the previous slide, this is primarily reflective of some delays we've seen in Q4, which have materially impacted the revenue during the period. It's worth noting that these delayed revenues relate primarily to the security solutions and managed services and warranties lines within this division. It's promising to see that our advisory revenues grew by 18% on a year-on-year basis. We have noted significant demand for our consulting services within our Brookholt and Pentest businesses, which is great in the sense that it also does drive some additional visibility moving forward for that revenue line, which historically you don't always have a large degree of visibility on. Gross profit margins of 20% are slightly suppressed in the year compared to the prior year. And as mentioned on the previous slide, it does take into account the one-off unrealised exchange expense in the period, as well as some of that initial investments into adding headcounts to support future revenue generation. Overheads within the services division have increased during the year, and this actually reflects some one-off costs relating to infrastructure upgrades across the division, and also some one-off items such as recruitments of adding those additional revenue-generating staff during the period as well. Adjusted EBITDA for the division of 100k does incorporate and is impacted primarily from those revenue shortfalls as mentioned above. Moving on to our software business, it's pleasing to note actually our repeatable and recurring revenues have remained strong. Our renewal rates of circa 80% demonstrates support from our long-standing client base within our Secure Envoy business. We have seen lower than expected new business within our software division during the period, with some opportunities taking a little bit longer to conclude. And I think moving forward, it's pleasing to see that the newly released version 3.1 Secure Envoy product will provide opportunities to further push new business in this division moving forward. Gross profitability within the software division of 63% is slightly reduced on a year-on-year basis, and this is impacted slightly by some one-off additional hosting charges that the division has incurred, which has been incurred in order to drive the delivery of new product sets. So moving forward, these are one-off costs which will adjust back down. So we would like to think that profitability will return to prior year levels at a gross margin level. Overhead increases are slightly up year on year from 700k to 800k, and these reflect inflationary expenses, inflationary increases to our cost base. However, we have offset some of these inflationary challenges with increased efficiencies across the division, as well as sensitive reductions in other areas. Adjusted EBITDA of 1 million for the year delivers a 34% adjusted EBITDA margin. Moving on to the next slide. This next slide just provides a brief summary of the group's cash movements during the period. I won't go through every single line here. I'll try to pull out some of the key movers in the year. So firstly, starting with the group's operating cash flows as at the 31st of March 23. These were obviously positive in the year. However, they do also include some one-off costs, so that additional investment into headcount and some in infrastructure costs are incorporated within that operational cash generation figure. And in addition to this, there is some one-off exceptional items, and these relate to the first part of a group reorganisation which started towards the end of Q4. Other items to note are capital expenditure of 1.3 million, up from 1.1 million in the previous year, and the majority of this spend is in relation to investments in internally developed R&D to develop our new software offerings. The other items to note, in the previous year, we've paid back the final loan balances held by the group. So at 31st of March 2023, the group has no loans outstanding, with the exception of leases for buildings. And the business continues to collect cash efficiently, and to date it has not utilised the RCF facility in place. With that, I'd like to hand back to Phil.
Thank you, Paul. Right, now I'd like to take you through a couple of slides. The first one being the strategic direction. We remain steadfast. It is our vision to become the preferred provider of choice. We want to deliver the next generation cyber technology, professional advisory and advanced cybersecurity services and solutions. Our initial focus will be on the short term is on building organic revenue and delivering solid, sustainable revenues and profit growth in the years ahead. Our organic growth will be achieved through helping our company solve core scaling issues, providing capital and infrastructure where required, cross-selling across the group, securing new customers, and supporting product innovation. Our long-term strategic goal is to grow via focused acquisition, acquiring companies which complement the group, building shareholder value, and that's on both the services side and on the software side. And to conclude, our current trading, just to give you a little bit of an idea of how Q1 started up. We saw a strong Q1. Trading was driven by high customer engagement and the fulfillment of some of those delayed orders that Paul spoke about. This all underscores our robust prospects and complemented a healthy balance sheet, and an ongoing relevance of our solutions is addressing modern day security demands. Anticipated fiscal 24 cash generation further reinforces our promising outlook. When you look at the opportunities inside the group, the company aims to enhance its services division by expanding its blue chip client base, increasing the shares of recurring revenue from its existing clients. As we see our customers buying longer term or buying annualized contracts, but having those in place for multiple years, sweating their assets, we do expect to see an extended range of new recurring revenues and lasting well into the future. We'll also be looking to expand our offerings, both in our services and our software division. With our continuous investment in R&D, we do expect additional softwares and features and functionality to come out of our software division. And with our services division, I'm glad to report that our service offerings that were recently launched last year are all now generating cash and opportunities. We aim to facilitate more cross introductions between our existing blue chip services customers and our software products. We own the IP. It's a highly profitable business, and what we've done, we've incentivized our teams to actually take these products to market and sell those to our existing customers, and to also generate new prospects as well. And I'm glad to report that the take up and the interest in our new softwares is growing. A number of POCs and presentations and client meetings have been taking place since the beginning of this fiscal year, and we expect that number to grow and obviously show some return as the year progresses. So with all of those things in mind, I'd like to think that there is a very positive outlook for the group moving forward. And with that, I believe that concludes the presentation today, and therefore I'd like to open up the floor for questions.
Perfect. Phil, Paul, thank you very much for your presentation. What I'll do is I'll just bring your cameras up now. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab, which is situated on the top right-hand corner of your screen. Phil, Paul, we've received a number of questions, and I want to start off the Q&A session with this one here, which reads as follows. How exactly will the work you've been doing to merge group companies drive an increasing number of opportunities moving forwards?
I think that one's best for me to answer. There's a couple of things. First of all, I'll just address the side of Secure Envoy and GeoLang. Obviously, GeoLang was a pre-rev technology company when acquired. What we did is obviously invest in it over the years. We've got the product installed with the customer. It's been constantly developed during that period as well, in partnership with the client. And we've now got an enterprise-grade technology. And as opposed to just restricting it to the customers that we have already inside the group, we wanted to use the platform of Secure Envoy. They have a very well-established brand name. They have a very well-established distribution network of resellers internationally. And this would allow us to make their product available to all those resellers, multiplying up the amount of salespeople that will be able to talk and introduce this technology set to their client base. So that's one side of it. It also meant that we could bring together the programming teams. We could get greater efficiencies out of those teams and the staff. It also meant that the quality controls and all those things would fall underneath the rigor process of Secure Envoy's very well established programs. And so all in all, from that perspective, it made perfect sense to do so. And we're already seeing that obviously there's been new software announced from Secure Envoy independently. The GeoLang software is now out there. It will be marketed as sensitive data discovery. It will be the company will be Secure Envoy, and we will obviously we've incentivized the sales team to actually go out and sell this to make sure that this all works and happens for us. On the services side, we're merging Exena IS, Exena Consulting into Brookcall. That's the plan. It's currently under process. And what we're looking there for is once again, efficiency savings. We're looking for reduced administration costs, simpler message, easier to actually go to market, and that's what we will gain from this. We also, when you look at it from the business side of things, where the rubber hits the road, the team at Exena will be able to represent themselves now as part of a larger company. They'll also be able to use the ISO badges that Brookcall have, and we have 5 of those, which will complement what they have. It will also mean that we can take the Exena accreditations that they have for audit and bring those into Brookcall. It will increase the profile of Brookcall with its own customers. We have many blue chip customers there. And what I'm expecting is to see a more greater awareness from our existing Brookcall client base to understand more about the services Brookcall can offer. And one of those services being Xena Consulting and their array of audit and advisory services. It will elevate our opportunities, and we believe that, along with the general savings of administration, the practical ones is it creates a lot more opportunity for both the services side and the software side.
Perfect. Thank you very much, Phil. Maybe another question for you. Maybe could you give us a flavour of the type of customers you're engaging with in the current year?
Certainly, yeah. We typically deal with branded fortune companies. You would know all their logos. We do have all sorts from telcos for international high street banks. We have chemists. We have leading sportswear manufacturers, international clients. We have petrochemical companies. These are a lot of our customers have been very long-standing, and I'm glad to say that there's some repeatable and recurring revenues in all of those. And one of the things you must consider is the reason that some of these contracts get delayed is because of the sheer size of the contract and the magnitude of work that the customer has to do. They're international by nature, they're long-term, it's a huge investment. And but that is the nature of their client base. We're dealing with those big customers, and sometimes there are some delays simply because of the customer's infrastructure and their availability to actually complete their work. But these would all be, I wish I could give you the logos and the names. Unfortunately, it wouldn't be the sort of practice to actually give out customer logos of where we look after their security for them.
Perfect. Thank you very much, Phil. Do you expect to enter new territories globally in the current period?
Yes, we do. So there's a couple of things. From our services division, predominantly, we're client-led. So a customer will, and we get involved in lots of international engagements across Europe and international global deals. And we will go where the client requires us to go. And we look at the most efficient routes to actually deliver that business. And these things have to be done under bid and tendering rules. Generally, they have to be economical, superior to competition. They've got to be efficient, and we've got a reputation in delivering that. So we do expect to see an increase in that activity as, so to say, some of our clients will catch up with their international rollouts. On the software side of things, we're proactively looking for additional territories for our software distribution. Obviously, the more territories we can cover, the more use and more business we can pick up in that region. So that will be an ongoing program.
Perfect. Thank you very much. The next question reads as follows. Can you provide more detail on the R&D spend and where you're seeing the most benefit?
Paul, is that one for you, or do you want me to lead with that?
I think in terms of the R&D spend recently, obviously, it was circa 1.3 million was our intangible spend during the period, of which probably about 1.2 million was specifically spent on development of Secure Envoy and GLang product sets. We have spent time during the year looking to make our R&D teams more efficient, which very pleasing to say has got us to a point where new product sets have recently been released in Q1. I think moving forward, the level of spend feels appropriate, and I think following the recent launches of the Secure Envoy product, we'd like to be hopeful that we will start to drive some incremental revenues from this point.
Perfect. Thank you very much. Next question here is from Patrick L. Service revenue was sharply reduced from your two largest customers in FY23 compared to the prior year. Is this reduction lost contracts or just delayed renewals?
I think that's probably more suited to me. We have long-term customers who have been very established with us for a very long period of time. They're still customers. They have huge projects, and some of these projects do get delayed. Then this is simply a delay of project. They're not lost. The requirement for the customer is still there, and obviously until we have successfully delivered some of those delayed orders already. The remaining delayed orders, we'll give you further announcements as and when we can at post-period end H1. But yeah, they're not lost.
Perfect. Thank you very much, Phil. Next question here. An 80% renewal rate within software might be consistent but appears low. Do you have a view on this, and what rate do you target?
Obviously, we'd like to target higher. One thing you've got to realise is when Secure Envoy was acquired, the product set there was a lot smaller than it is today. Its features and functionalities were a lot smaller. So where you see obviously some of those declines, they would be expected. What we've done over the last few years is actually invest, and the team have been working really hard to actually bring together the, so we say, product set for today and tomorrow. We're now on-prem in the cloud. We now cover multiple devices. We now got geolocation. We now got OCR technology. We've got all these features which are needed today to actually meet compliance and regulation and security requirements. So, the 80%, would I like to see that grow? Absolutely. What we are also seeing is some clients are sweating their assets a little bit longer, so maybe that will contribute to an increase in that. But 80%, I don't know how that measures up against industry averages. Obviously, people like Microsoft, I imagine everyone has to renew that one. But there's other technologies out there. I don't know if 80% is a good mark or not, to be honest, for the software. Paul, I don't know if you've got any more colour you can add to that.
I think the point to make on the 80% renewal basis, and whilst very early days, I think adding the new product sets in Q1, we would like to expect that will have a positive impact on customer retention moving forward, because obviously additional functionality gives a hook to some of our existing clients. To obviously gives them another reason to stay with us.
Perfect. Thank you very much. Just turning to the next question here from Paul B. If the EBITDA losses were driven by timing on customers, will 2023-2024 EBITDA performance result be an upgrade to forecast in the market?
Unfortunately, we're not allowed to forecast, but you can obviously gain access to Senko's Note through Research Tree, and they will give you some guidance there. Paul, is there anything you can add, any colour on that?
I suppose just to add to that slightly, obviously we've noted that current trading is ahead of the prior year, and Q1 was in line with management's expectations. So obviously we're trading ahead of the prior year, but again, obviously it's not something we can't forecast moving forward. Upgrades or anything like that, not at this stage.
Perfect. Thank you very much. And Phil, perhaps one for you. Who are your main competitors in the service division and the software division?
Well, the good thing is when you look at our companies, they're all award-winning. They've all won at least one award out there for customer service, innovation, productivity. So we do have competition though. We are a specialist company, so there's very few companies that are as pure as what we do. There's lots of generalist companies that will have, for example, a department that do some pen testing. But we have a company that does pen testing. There's also a company that has won numerous awards on the international stage. They service high-end client base of technology companies. And there's no greater accolade, I don't think, than when companies from your own industry sector use your skill sets to test their technologies. So from a pen testing perspective, there are people that will do it cheaper, but I don't see them doing it any better. From a Brookfield Solutions perspective, there's a lot of resellers out there that will sell the product set and don't add the service. We've managed to keep hold of our key clients for north of 10 years, and that list is growing. So our service is king there, and that's the thing that keeps us in there. So we're lucky that we don't see many companies like Brookhall out there. There's been a few that have emerged. Some have no longer with us. Some of them have been bought out. Some of them gone back into PE. And so there's very few companies that are like a Brookhall. Xena, that's great proposition there. They deliver the same services as the Big Four, apart from they're cheaper endpoint, and the skill set you actually get the person with 20 years experience. So once again, it comes down to a service offering. Our services, we believe, are far superior than our competition. On our software side, it's all about innovation. It's all about addressing technology gaps, and it's looking for, even in the crowded market space, everyone says, well, I buy Microsoft. And what we're seeing is a lot of our customers are saying, well, Microsoft's great, but we need Microsoft plus one, because it's not quite so focused on where we need it. So they're now looking for those focused companies, which is where we have things like GeoLang data discovery and Secure Envoy's access management platform. There are many big secure envoys out there, a lot bigger than those guys, and but their prices are more expensive. Their quality of service isn't as good, and that's simply because of the volume of people. And the way we attract people is obviously, once again, on that service and quality offering, and the price point. It's particularly in today's environment, that price point becomes more important. With GeoLang, we're plugging a technology gap where there's certain technologies out there which need, for compliance and security reasons, need to be monitored, need to be filtered, need to be controlled, and we're able to do that with the tool set that we've got. And this tool set is not widely available, through competition. There's a couple of companies out there that do a little bit of what we do. There's some other bigger companies that do some of what we do, but not so well. So we're, the types of organisations we're talking to are, once again, leading blue chip companies. And obviously, with the new versions that have now been released, we're hoping that those conversations will materialise. And I would like to think that there will be an opportunity for us to expand our software revenues as a result of that. So competition-wise, it's very difficult. Big generalist companies are available, but we're seeing our client base looking more at some of those focused companies who can specialise and be more pure with the offering. Hopefully that's a bit long-winded, but hopefully that answers your question.
Perfect. Thank you very much, Phil. Just turning to the next question from Richard. Clearly, getting new contracts is the key to the financial health of the business. Are you offering special deals to entice new customers to sign up for 1-year deals, for example?
What we do a lot of international business. We do an awful lot of multiple year contracts. We are seeing a lot of those contracts, some of those contracts being 1-year ones with the options to renew. We try and turn away from the buy one get one free, simply because of, as soon as you've got the customer in the mindset of I can get it cheaper, you never get them out of that. So obviously we want to sell to maximum value. So what we do, we work very closely because of the size of some of these deals, and you've probably seen in some of the RNSs, they're multi-million-dollar deals. We work very closely with the manufacturers on the services side, and that sometimes there is special bid pricing that's offered, but the customer has to make a large commitment. So it's a coordinated event in actually achieving that. On the software side, there have been instances where there's been special offers, promotions on, especially when launching new technologies and things, and to get the buzz, we incentivize it, and we want to get it moving. So we will look on those on a case-by-case basis. But generally speaking, we want to try and steer away from buy one, get one free type of approach.
Perfect. We've got another question here from Duncan. Lots of hope has been expressed, but no scale offered on either division. So what practical comfort can shareholders draw given the decline in revenue last year and collapsed share price? Some comforts are required if the valuation is to improve. Had any comments on that?
I've got no control over the share price. I'm a large shareholder, as you know, so it pains me as much as it does every other shareholder. And in terms of what comfort, there have been delayed orders that we spoke about earlier. Some of those delayed orders have come in, and when you look at prior to fiscal 23, when you go back 2022, 21, 20, we were lucky enough, fortunate enough, to actually show progression. And I would like to think that whilst we've had these macroeconomical challenges, I would like to think that as some of those clouds clear, there will be an opportunity for all of us, not just us. And you'll read it in the press. It's other companies out there in the IT industry are still are having a tough time, and I think all industry is, full stop. And I think with some of those challenges clearing, I think there'll be an opportunity for us to rebuild. We're going to be focusing on our organic growth. We're focusing on getting our cross-selling improved. We're incentivizing the sales team to go out and sell our homegrown technologies as well, because they do yield a greater margin. And with all of those sort of things in play, we would like to think that they will contribute to a positive story, and then it's up to the markets, to the shareholders, to dictate what our share price is going to be.
Perfect. Thank you very much for that, Phil. We've got one final question here from Guy. How are you managing consulting staff resources in response to the large year-to-year variations in revenue?
We before COVID, we had made some adjustments to our consulting base, or to our business full stop. And when we went into COVID, obviously we didn't know how long that would be, how long it would last, and we kept our teams on. We wasn't expecting it to last as long as it did. We didn't expect the change in working practice to morph the way it did. The face-to-face meetings are taking place again. We're seeing increased activity in that. Along the way, we did lose some people. We made some efficiency savings, and those efficiency savings were not just in the consultants, but obviously some of the lines of business that we were chasing after from an audit perspective or an advisory perspective. The business at the moment is very focused in what it's delivering, and what that allows us to do now is we have a good team, and now we believe that with the merger of our consulting, our advisory consulting coming to Brookcore, it will give a better platform for them to grow. And so we'll be monitoring that very closely. When you look at our pen testing team, we did struggle in finding some staff, and so we had to push out internationally. You can't always get the people you want in the UK, unfortunately. So we do have international staff that contribute to what we do. We have found and taken advantage of some of those price points. Labour rates in some other countries are cheaper. We still keep our core, obviously, in the UK, but we do add to that. And obviously, where we have peaks and troughs of demand, we do bring in contractors. And that's simply what we're looking to do, is make sure that we don't employ only to have to make them redundant. What we're looking for is obviously just to manage the peak of the time. We're looking to drive, obviously, utilisation rates up. They're at strengthened levels to what they were during the COVID period, but we think there's still room for improvement. So we'll be driving that quite hard to make sure that those rates do improve.
Perfect. Phil, Paul, thank you very much for that. I think you've addressed those questions you can from investors. And of course, the company will review all the questions submitted today and will publish those responses on the Investor Meet Company platform. But just before redirecting investors to provide you with their feedback, which I know is particularly important to the company, Phil, could I just ask you for a few closing comments?
Yes, by all means. So obviously there is these are disappointing numbers. I hope you understand that some of the challenges that we've had when you're dealing with large corporates of the nature that we do, you can't demand that they do things in a certain time frame just to suit you. These big elephants will wander along at their own speed. These are long-standing customers. We've got great confidence in what they do. They have confidence in us in delivering, and we expect that those will continue to be great working partnerships. So despite 2023's report, I would like to think that there's great value inside Shearwater and what it delivers to the market space. I would like to think that you can see that as well. Thank you.
Oh, Paul, thank you once again for updating investors today. Could I please ask investors not to close the session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Shearwater Group PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.
Thank you.